It's your boy Sack coming to you with today's stock pick. Remember, this channel is all about no face, just facts in less than 5 minutes. Let's get started. Today we're breaking down one of the most powerful indicators traders use to predict stock movement, the Fibonacci retracement tool. And we're using CGNX, also known as Cognex, as our example. Looking at this chart, CGNX is up more than 124% over the past year. That matters because Fibonacci works best on strong trending stocks. The stronger the trend, the more reliable these levels become. Now let's clear something up. Fibonacci is not magic. It doesn't predict exact prices. What it does is identify probability zones where traders are likely to react emotionally. These are areas where buyers may step in, sellers may take profits, or institutions may accumulate shares. The main Fibonacci retracement levels traders watch are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. The most important level is 61.8%, also known as the golden ratio. This is where professional traders pay the most attention because major reversals often happen around this zone. Now let's apply this to CGNX. The first thing traders identify is trend direction. Looking at the chart, CGNX is clearly bullish. The stock has been making higher highs and higher lows throughout the year, which tells traders buyers are still in control. When using Fibonacci in an uptrend, traders draw the retracement from the swing low up to the swing high. Once the tool is applied, it automatically creates support zones where the stock may pull back before continuing higher. The first level is 23.6%. This is considered a shallow pullback. If CGNX only retraces slightly before bouncing higher, that usually signals very strong momentum because buyers are aggressively pushing price upward. Next is 38.2%. This is one of the most common support zones during healthy uptrends. If CGNX pulls back into this area and buyers return with strong volume, traders often see that as trend continuation. Then comes the 50% retracement level. Even though it's not technically a Fibonacci number, traders use it heavily because markets naturally tend to retrace about half of a move before continuing. Finally, we get to 61.8%, the golden zone. If CGNX retraces toward this level and buyers suddenly step in aggressively, traders may interpret that as institutional accumulation before another breakout. Now look at the right side of the chart. You can see a strong breakout candle pushing sharply higher. That's important because explosive candles often reveal momentum acceleration and aggressive buying pressure. But stocks never move straight up forever. Eventually, every stock consolidates or pulls back. Fibonacci helps traders prepare for those pullbacks before they happen. Instead of emotionally chasing the stock after a huge move, traders identify retracement zones ahead of time and wait patiently for opportunities. That's why Fibonacci is so valuable. It changes trading from emotional guessing into probability-based planning. Now here's the key rule. Never use Fibonacci by itself. Professional traders combine Fibonacci with confirmation indicators. One popular tool is RSI, the Relative Strength Index. If CGNX reaches a Fibonacci support zone while RSI becomes oversold, that increases the probability of a bounce. Volume is another important signal. If buying volume increases near a Fibonacci level, traders may interpret that as institutional buying activity. Candlestick patterns matter too. If CGNX retraces to a Fibonacci level and forms a bullish engulfing candle or hammer candle, traders often see that as confirmation buyers defended the zone. Another concept traders use is called confluence. Confluence happens when multiple indicators align together. For example, if the 50-day moving average lines up with a Fibonacci retracement level, that creates a stronger support zone because multiple traders are watching the same area. Now let's talk about beginner mistakes. Most traders fail with Fibonacci because they force it onto every chart or draw the levels incorrectly. Fibonacci works best on stocks with strong momentum and clear trend direction. And remember this, Fibonacci identifies probability zones, not guarantees. Looking at CGNX overall, the stock still appears bullish. Momentum remains strong, buyers continue defending higher prices, and the recent breakout candles suggest institutional interest is still active. The biggest takeaway from this lesson is simple. Fibonacci is not about predicting the future perfectly. It's about understanding where human psychology tends to repeat itself in the market. And when enough traders watch the same levels, those areas often become self-fulfilling. Like, subscribe, and comment some stocks you want to hear about as we continue our journey toward 10,000 subscribers.